Analysis and communication of accounting information. How to start and finish studying. Have a bird's eye view of the entire syllabus. Study each topic thoroughly. Work out examples, illustrations, and exercises. Repeat until you understand. Practice exam questions. Practice mock exams. Simulate exam conditions and practice. Analysis and communication of accounting system. This is second part, part 2, limitations of financial statements. In this lesson, we learn everything about limitations of financial statements, analysis and interpretation of financial statements, calculation of ratios from the financial statements of a business, how to use ratios to analyze the performance of business, how to explain and how to explain ratios, how to explain and how not to explain ratios. Altogether, we discuss and practice questions based on these concepts. Identify and practice for examination questions. Questions will be practiced from AS level and A level both. The limitations of financial statements for shareholders and other interested parties. The purpose of financial statements such as the income statement and statement of financial position is to present information in a meaningful way. That is why items in financial statements are placed in groups of similar items, non-current assets, current liabilities, and so on. It also explains why you should compile financial statements with every item in its correct place. Accounting standards are intended to ensure that items included in financial statements and described in similar items are calculated as far as possible on the same basis. Companies' acts and accounting standards require companies to add numerous notes to their financial statements to throw more light on the items in the accounts. To be useful, information must be clear, complete, reliable, and timely. In spite of the efforts of numerous accounting standards to ensure some sort of uniformity in the presentation of financial statements, the published accounts of limited companies have a number of limitations as communications and information. They are not clear to people who have an adequate knowledge of accounting and finance. The information they give is not complete. Legislation and accounting standards recognize that companies are entitled to keep certain information confidential because publication would give competitors an unfair advantage. The comparability of financial statements is only relative because companies are permitted to exercise a fair degree of subjectivity in selecting their accounting policies. Depreciation, provision for doubtful debts, inventory valuation, and treatment of goodwill are examples of areas where there can be some variability in the application of judgments and making of the estimates. Companies are allowed to depart from the accounting standards if such departure is justified by the nature of their business and will improve their quality of the information provided by the accounting statements. By their very nature, published accounts are of historic interest. They may not be published for many months after the end of the financial year they cover. In the meantime, many circumstances may have changed. The economy may have improved or worsened. The political scene may have altered. New technologies may have been developed. Fashions may have been changed. The company's performance may have improved or worsened because the data of the statement of financial position and its publication. The director's report may help to overcome some of the limitations of the financial statements, but not completely. The director's report may help to overcome some of the limitations of financial statements, but not completely. Only people with some knowledge of accounting are able to make such senses of the mass figures in a company's financial statements. Even accountants need to interpret the figures before they are able to understand the significance. As a useful tool for interpreting accounts, accountants calculate ratios that relate certain items in the accounts to other items where there should be some sort of sensible relationship. The uses of financial statements were covered in chapter 22. However, it is important that you know the internal and external uses of the financial statements and the reasons why they review them. Internal users. The internal users are the owners of the business, existing shareholders, managers, and directors. The owners of the business review reasons for reviewing the financial statement. To assess the overall performance of the business, to identify problem areas such as poor gross margin, to change in gross or net margin, to identify areas where corrective action can be taken to improve future performance. Existing shareholders, to assess these are the owners of limited companies, although we have seen that they may not take any part in the day-to-day management of the company. To assess the overall performance of the business, to consider the security of their investment, look at the return they receive in terms of dividend paid. Managers and directors. Often the salary of owners paid to these employees is based on performance of the business in certain periods. Thus, they will be interested in the key performance ratios, salary and bonus. Workers. They too will be interested in the performance to see if the future pay or sales salary increases will be made. External users, banks, future shareholders, investors, suppliers to the business. Banks, they will be interested to assess whether a loan or overdraft should be granted to the business. If one already exists, then they will be interested to see if the business can maintain the repayments. Future shareholders, a different group from existing shareholders, they will be comparing the returns from several businesses to decide where to invest in. Investors, to determine that the return they will receive and the security of their investment. Suppliers to the business, their interest will be to decide whether or not to supply a business. Alternatively, they can also, if they do supply, to check that they will be paid on a regular basis. Customers of the business, they will be assessing the performance to see if the business will be able to supply them in the future. Government, to determine levels of taxes will be charged on the profits of the business to decide whether or not to give grant to the business. Local community, many of the local community may be customers of the business or may seek employment with ease. Thus, they will be interested in seeing if the business will continue to operate in the future. Trade unions will be empowered by the business that they will look at profit to see about future pay increases. The general community, interested in whether or not the business is operating ethically towards its workers, customers and environment. A pyramid of ratios. This is the comprehensive list of ratios. The ratios that when accountants use may be represented as a pyramid, which classifies the ratios into useful types and shows how they relate to one another. So, profitability ratios, ratios in utilization of resources, financial ratios, investment ratios. So, what are profitability ratios? Return on capital employed, primary ratio, profit before interest and tax as percentage of revenue, secondary ratio, profit margin, gross margin, operating expenses to revenue ratio, markup. The ratios showing utilization of resources. Revenue as a percentage of capital employed, non-current assets turnover, net working assets to revenue. Financial ratios, current ratio, liquid asset test ratio, trade receivables turnover, inventory turnover, trade payables turnover, working capital cycle. Investment ratios, gearing, debt to equity ratio, interest cover, income gearing, price earning ratio, dividend cover, dividend yield, dividend per share. Profitability ratio, the primary ratio, return on capital employed. The test of good investment is profitability that if the reward it takes on the amount invested in it. Profit and profitability should not be confused. Profit is expressed as an amount of money. Profitability is a ratio that relates profit to the amount invested. First, the primary or profitability ratio for the investor is the return on capital employed. It relates profit before interest and tax to the capital employed in the business. The formula is profit before interest and tax upon capital employed. So, this is also known as operating profit. Profit from operations or operating profit upon capital employed. So, perhaps an easy way to remember is profit upon capital employed, where profit is nothing but operating profit. So, capital employed is the total of the ordinary shares plus reserves plus non-current liabilities. So, non-current liabilities are nothing but debentures and other long-term loans. Return on equity. An alternative to calculating the return on capital employed is to calculate the return on equity. The ratio identifies the return made by the business for the ordinary shareholders. The decision whether they should remain as ordinary shareholders in the company or look for a better return elsewhere can be based on this ratio. The formula is profit after tax or profit for the year after divided by upon ordinary share ratios plus reserves. So, this is also known as capital employed, shareholders funds into 100. In effect, we are dividing the ratio of profit for the year which belong to the ordinary shareholders, profit after tax or profit for the year divided by ordinary shares issued into 100. Return on equity. So, an alternative to calculating the return on capital employed is to calculate the return on equity. This ratio identifies the return made by a business for ordinary shareholders. This will remain as ordinary shareholders in the company or else with return. Elsewhere can be expressed on this way. The formula is profit after tax or profit for the year upon ordinary shares plus reserves into 100. So, in effect, we are dividing the profit for the year which belong to the ordinary shareholders, profit after tax or profit for the year divided by ordinary shares into 100. Profit before interest and tax, profit from operations as a percentage of revenue or sales, or profit from operations as a percentage of revenue or sales. This ratio is a measure of how efficient the management is at generating profit from trading activities. Finance costs and tax charges are excluded. Profit margin. This ratio shows how much profit for the year generated from revenue. It can be calculated by the following formula. Profit for the year upon revenue into 100. So, this can be considered as profit on sales. Gross margin. So, both gross margin and markup are discussed in relation to preparing accounts from incomplete records. See chapter 16 also. So, in IGCSE level, also this has been discussed. However, they will be reviewed again here. For starting with gross margin, the ratio shows how much gross profit each dollar of revenue generates. For many business, this ratio will be broadly constant until the business or suppliers change their pricing. For example, a garage selling the petrol might expect to earn a gross profit margin of about 0.05 for every $1 of petrol sold. A furniture selling, on the other hand, would be looking for about $0.025 for every $1 of revenue. The formula for gross margin is gross profit upon revenue. This can also be referred as gross profit ratio. The reduction in the gross margin may be explained by a number of factors. A rise in the profit price of goods purchased may not have been passed on to customers. It may have been necessary to purchase the goods from a different supplier at a higher price. The selling price of the product may have had to be cut to increase the volume of the sales to fight competition from other businesses as an introductory offer for a new product, as a result of seasonal sales, to dispose of out of date or damaged inventory, to increase cash flow when the business is short of cash. The cost of sales may have been increased by the theft or inventory. The important thing to remember is that it is a change in the selling price per unit or the purchase cost per unit which will increase or decrease the gross margin. Operating expense to revenue. Having identified that the gross margin is partly to be blamed for the loss and profit, the next thing to determine is whether or not managers have been able to control the business expenses. This is done by calculating the operating expenses to revenue ratio. The formula for this is operating expenses, that is operating expense, administrative expenses plus distribution cost plus finance cost, divided by revenue into 100. Markup. The final ratio to consider in this section is markup. This ratio measures by how much the business marks up its cost of sales to arrive at selling price. The formula for this ratio is gross profit upon cost of sales into 100. This is profit on cost. So ratios showing the utilization of resources. The profitability of a business depends how efficiently it uses the resources, and the next group ratio is designed to test utilization of resources by the business. Revenue as a percentage of capital employed. Capital invested in a business must be utilized efficiently if it is to produce a good return on capital employed. Capital of $100 producing sales $300 is being used more efficiently than the same capital producing sale of $200. Sales are expressed as percentage of capital employed. This is found by dividing the revenue by the capital employed. The ratio of profit before tax and interest percentage and revenue as a percentage of capital employed are known as secondary ratios because they help to explain the primary ratio, return on capital employed. If the two ratios are multiplied together, they give the primary ratio. Utilization of total assets. It is important for managers of a business to determine how well the non-current assets are being used to generate revenue. The main reason for purchasing non-current asset is for it to either generate revenue for the business or reduce costs, both of which will hopefully increase the profit. This is done by calculating non-current asset turnover ratio using the following formula. Net revenue upon total net book value of non-current assets. This will give the number of times the non-current assets are turned over. Net current assets to revenue. This measures how effective management has been in generating sales from its working assets. Working assets means its inventory which is bought to resell and make profit. Trade receivables and trade payables. The formula to calculate this ratio is net working assets, that is inventory, trade receivables minus trade payables upon revenue into 100. So financial ratios. It may seem strange to have a group of ratios known as financial ratios when everything we have looked at so far have involved money. However, most textbooks will class the following ratios under the main heading of financial ratios. The first two ratios in this section though are known as liquidity ratios. Liquidity is a measure of how well the company is able to pay day-to-day running expenses. There are two main ratios to consider. Current ratio. This shows the relationship between the current assets of the business and its current liabilities. Current assets are funds out of which a business should pay its current liability. You should never have to sell non-current assets to pay its trade suppliers. It follows that there should be a margin of safety between the current assets and the current liabilities. The current ratio expresses the margin in the form of true ratio. Current assets is to current liabilities. So that is the current ratio. Current assets is to current liabilities. Textbooks often state that the current ratio should be between 1.5:1 or 2 and 2:1 to take account of slow moving inventory and slow paying customers. But much depends upon the nature, the kind of business. While a low ratio could signal danger, a high ratio may indicate the business has resources that are not being used efficiently. High levels of inventory, trade receivables and cash mean that the capital is lying idle in the business instead of being used profitably. The current ratio is sometimes described as an indication of liquidity, but that is incorrect. The liquidity of business depends upon the liquidity of its current assets. A liquid asset is one that is in the form of cash, cash and bank balances, or in a form that may become cash in the short-term trade receivables. Inventory is not a liquid asset. No buyer has yet been found for it. The current ratio calculation includes inventory, so it is not a measure of liquidity. Liquidity is measured by the liquid asset test ratio. Liquid or asset test ratio. The liquid or asset test ratio excludes inventory from the calculation and ensures the proportion liquid assets, trade receivables and cash that is available to pay the current liabilities. The ratio is calculated as current assets minus inventory upon current liabilities. Trade receivables turnover, also known as average collection period. A business should have set a limit on the amount of time it allows to customers to pay a credit period. Many customers take longer than the time allowed, and the customers ratio calculates the average number of customers are taking to pay. Average time customers are taking to. The formula is trade receivables upon credit sales into 365 days. Only credit sales will be used in the formula. If you are given both cash and credit sales, or perhaps cash sales as a certain percentage of total sales, the cash sales must be excluded. Generally, the answer should always be rounded up to the nearest whole day. This is the case even if the answer comes out at say 26.12. This should be rounded up to 27 days, the next figure, so that is 27. Inventory turnover. Inventory turnover is the rate at which the inventory is turned over, or the time that elapses before the inventory is sold. This ratio is important for the following reasons. The more quickly inventory is sold, the sooner the profit on it is realized, and the more times the profit is earned in the financial year. A slow turnover may indicate that excessive inventory is held and the risk of obsolete or spoiled inventory increases. Large quantities of slow moving inventory means that capital is locked up in business and is not earning revenue. However, different traders have their own expected rates of inventory forever. Food shops will expect to have a fast inventory turnover if their food is not to deteriorate before it is sold. On the other hand, shops selling furniture, refrigerators, radios and television sets, etc. will have slower inventory turnovers, while manufacturers of large items on plant and shipbuilders will have very high long inventory turnover periods. Generally, fast moving inventories have lower profit margins than slow moving inventories. Compare the profit margin to be expected on the sale of food with that expected on the sale of motor cars. The formula for calculating the rate of inventory turnover is cost of sales upon average inventory, where average inventory is equal to opening inventory plus closing inventory divided by 2. It is important to take average inventory because closing inventory may not be representative of normal inventory level. If opening inventory is not given, use closing inventory for the calculation. This calculation will give the number of times a year the inventory is turned over. It is also acceptable to express it as the average number of days or months inventory remains in the business before it is sold. Inventory turnover can be calculated as a number of days. This is done by dividing 365 the days in a year by the number of times inventory is turned over each year. So notice that the number of days doesn't work exactly. Your answer must always be rounded up to the next whole day. Always check whether the question is asking for the inventory turnover as the number of times or number of days. The cash at bank. It is not necessary to make up a formula for cash ratio. It is sufficient to refer to the balances, and in the case of any company, draw attention to the fact that the bank balance has fallen from one amount to another amount. When a bank balance is converted into overdraft, it may be appropriate to recognize the fact with suitable comment. For example, the change here could be as a result of increase in trade receivables turnover and a reduction in the number of times the inventory turns over. Both of these factors will cause cash to flow out of the business, resulting in a decrease in the bank balance over the 2 years. Trade payables turnover, also known as average payment period. This is calculated by using the formula trade payables upon purchases on credit into 365. As with trade receivables turnover, only credit purchases must be used in calculation. Any cash purchases are excluded if the question doesn't give any way of calculating credit purchases. The figure for purchases in the cost of sales is normally used. Overtrading. Overtrading may occur when a business increases its turnover rapidly with the result that its inventories, trade receivables and trade payables also increase, but to a level that threatens its liquidity. The business may become insolvent and unable to pay its creditors as they fall due. The result may be that the business is forced to close. The working capital cycle. The working capital cycle measures the time it takes for the cash to circulate around the working capital system. It calculates the interval that occurs between the time the business has to pay its creditors, trade payables, and the time it receives cash from its customers. It is calculated using the following formula: inventory turnover in days plus trade receivables minus trade receivables turnover in days minus trade payables turnover in days. So the working capital cycle of a company is found as follows. So we have to add rate of inventory turnover and trade receivables turnover, so which are current assets, and take out the number of days of trade payables turnover, which is a current liability. So the net amount is nothing but working capital. So that is nothing but cash operating cycle. So in both years, the company received its money from sales on average 11 days after it had paid its suppliers. During this time, the company was financing its customer out of its own money. Investment stock exchange ratios. Investment ratios are particular interest to people who have invested or to an internet to invest in a company. These people include shareholders and lenders such as debenture holders and banks. Gearing ratio. Gearing is fixed capital expressed as a percentage of total capital. Fixed cost capital is the money that finances a company in return for a fixed return and includes debentures and preference share capital. Total capital includes the equity, ordinary share capital and reserves plus the fixed cost capital. The formula is fixed cost capital, non-current liabilities such as debentures or long-term loans plus redeemable preference share capital plus divided by total capital, ordinary share capital plus all reserves plus non-current liabilities plus redeemable preference share capital. The answer is then expressed as a percentage by multiplying by 100. A company is described as highly geared if the gearing is more than 50%. If it is less than 50%, it is low geared. 50% is neutral gearing. The key word is understanding the importance of gearing is risk. Lenders of money to a company may be concerned if it is highly geared. This may indicate that a large slice of profit is applied to the payment of interest. Risk arises if profits fall and fail to cover the interest payment. Bank approached by highly geared company will question why. When the company is already heavily dependent on loans, the shareholders are willing to invest more of their money in their company. Perhaps they lack confidence in the company's future. The risk of ordinary shareholders increase in a highly geared company. Debt equity ratio. The formula for debt equity ratio is debentures for long-term loans plus preference share capital divided by ordinary share capital plus reserves. Interest cover. Debenture holders and other lenders to a company need to be sure that the profit before interest adequately covers the interest payments. Interest must be paid even if the company makes a loss, but it is reassuring if the profit before interest covers the interest payments several times. A good cover provides a safety margin against a falling profits in the future. Shareholders are also concerned to see a good interest cover, as their dividends can only be paid if the profit is left after charging the interest in the income statement. The formula for calculating interest cover is profit from operations upon interest payable. Income gearing. Income gearing is the interest expressed as a percentage of profit from operation. It shows to what extent a company can pay for its borrowings or what interest is as a percentage of the profit from operation. The formula is interest upon profit from operations into 100. The same answer could have been obtained by dividing 100 by the number of times for interest to cover calculated above. Earnings per share. Earnings are the profit left for the ordinary shareholders after interest, tax and preference dividends have been provided for the income statement. Ordinary dividends are paid out of earnings, and any earnings not distributed increases the reserves in the statement of financial position value of the shares. Earnings per share are expressed in cents per share and are calculated using the formula. Profit for the year minus dividend paid to non-redeemable preference shareholders upon the number of equity shares issued. Price earning ratio. This ratio is measured on how confident investors are in the future performance of the company. And the higher the PE ratio, the more confident investors are having the company earning capacity, earning profits in the future, and possibly paying ordinary shareholders an increased dividend. The price earning ratio calculates the what multiple of price being paid for the shares in the market is for the earnings per share. It is calculated using the formula market price per share upon earnings per share. Dividends per share. Companies usually declare dividends as a certain number of cents per share, representing a certain percentage return based on nominal value of the share. For example, a dividend of 0.03 per share paid on a share with a nominal value of 0.5 is a dividend of 6% on the share. Shareholders who have paid the market price for the shares needs to know the return based on the price what they have paid. The dividend per share is calculated using the following formula: the total ordinary dividends paid by total number of ordinary shares issued. The answer is expressed in dollars and cents. This presents a slight problem with the way accounts are presented. The statement of changes in equity shows dividends paid during the year. We have seen that this figure may not include dividends paid in respect of previous accounting period. The calculation of the ratio must be based on dividends in respect of the year in question. Dividend cover. The formula for dividend cover is profit available to pay ordinary dividend that is profit for the year minus non-redeemable preferential dividend divided by ordinary dividend paid. Dividend cover is the number of times the profit out of which dividends covers the dividend. If the cover is too low, a decline in profits may lead to the dividend being restricted or not paid at all. On the other hand, if the cover is high, shareholders may decide that all the directors are adopting the mean dividend policy. Dividend yield. This ratio shows the relationship between the dividend paid per share and the market price of the share. The share can be compared with the dividend yield of shares in other companies, or alternatively the return on less risky investments such as bank deposit accounts. It is calculated as dividend per share upon market price of one share into 100. It is usual to take the market price of an ordinary share at the end of the financial year. True trend analysis and interfirm comparison. Individual ratios are usually of very limited value. The ratios of business for past years are necessary to if trends are in progress or deterioration or performance are to be seen. The examples of a company and some limited trends have been observed. Given the results for say 4, 5 or 6 years, more reliable trends may be discerned. Trends may signal to investors whether they should stay with their investment or sell it and reinvest in more promising venture. Interfirm comparison is possible with more information about the performance of similar businesses is available. Trade associations collect information from their members and publish the statistics as averages for the trade or industry. It is thus possible to compare the results of one company with the averages for business of the same type. Comparisons, however, must be made with care. It is not realistic to compare statistics of a small trader with the results achieved by large companies. Comparison should always be on a like-for-like basis as far as possible. Interfirm comparison can inform shareholders whether they have invested their money in the most profitable and stable institutions. The limitations of ratios. To be useful and reliable, ratios must be reasonably accurate. They should be based on information in accounts and notes to accounts. Some useful information may not be disclosed in the accounts, and some account headings may not indicate the contents clearly. Information must be timely to be of use. It may not be available until some time after the end of company's financial year. Ratios do not explain the cause of the changes in results but may indicate areas of concern. Further investigation is usually necessary to discover causes of the concern. Ratios usually do not recognize seasonal factors in business. Profit margins will be lower than normal during periods of seasonal sales. Inventory and trade receivables are unlikely to remain at constant levels throughout the year. Companies even in same trade will have different policies for such matters as providing for depreciation, doubtful debts, profit recognition, transferring profits to reserves and dividend policy. Such limitations should be borne in mind when making comparisons between businesses. The benefit of ratio analysis are the opposite of its limitation. It allows managers to make comparisons between different years and between different businesses in the same trading sector. However, the business should ideally be of a similar size. It helps identify where improvements need to be made for the future. It allows a trend of performance to build up over a number of years. The critical appraisal of accounting reports. The basic of modern financial reporting and its limitation. The annual accounting reports of limited companies consist of an income statement, statement of financial position, statement of cash flows, and a director's report. These reports are prepared within an accounting framework made up of requirements of Companies Act and the various published accounting standards. These requirements are intended to ensure a degree of uniformity that will enable the users of the reports to interpret them in a generally accepted context. The framework has been considered in Chapter 22. Limitations of interpreting financial reports may be summarized as follows. While the accounting framework is intended to ensure that financial reports provide the information necessary for understanding the company's performance, the rules do not require confidential information which might provide an unfair advantage to competitors to be disclosed. The undisclosed information might, however, contain important clues to the better understanding of the company's performance. Companies are required to supplement the income statement and statement of financial position with the additional notes to explain how the items in those financial statements are made up. However, companies differ in this classification of many items of income and expenditure, and the rules may not be in sufficient detail to identify the differences. This may cause doubt on the usefulness of some accounting ratios calculated from the financial statements. Where accounting standards do not fit a particular business, the directors may adopt them or even ignore them provided they have good reason for doing so. Companies have different policies for the treatment of expenditure on non-current assets. Some will capitalize all the expenditure, while others will treat the expenditure as revenue expenditure as it is not material compared with the size of the amount shown in its statement of financial position. For example, a multinational company may not capitalize any expenditure on a single item, say equipment below 5,000. However, a small trader, any piece of equipment costing 5,000 will almost certainly be treated as a non-current asset in the financial statements. A company may own its extensive properties or it may operate solely from rented accommodation. One will pay no rent while the other may be burdened with some high rental payments. One will show the item in the statement of financial position while the other will show it in the income statement. This may make the comparison between the two companies using some ratios to be of little relevance. There are limits to the extent to which companies are considerably different from sizes can be compared. For example, it will be hardly helpful to compare the performance of a company with an issued capital of $50,000 with the performance of a company with an issued capital of $5 million. There may also be a difficulty in making a sensible comparison between a company with nil gearing and one that is very highly geared. Companies in the same line of business are often non-comparable. For example, some may simply retail their goods while in some others manufacture and retail them. Some companies may act as manufacturers and wholesalers only. Financial reports may be too historical to be useful by the time they are published. There will be a time delay of several months between the end of the financial year and date on which the accounts are presented to the shareholders at annual general meeting. The interpretation of financial reports may be subject to the external factors such as development in the states, general political and economic conditions of home and overseas, changes in fashion, market demand, and so on. The financial accounts and reports of companies and countries where there is high inflation can be seriously misleading if the accounts have been based on historic costs. Window dressing. Company directors naturally desire annual financial reports to present the company performance in as favorable as late as possible. Indeed, the remuneration may well depend on the profit the company makes. This may lead to window dressing, by which may take various forms, including reducing trade payables in the statement of financial position by drawing checks at the end of the financial year period to pay the creditors, but not posting the checks until the start of the next financial year, or even cancelling them on the first day of the next financial year. Reducing the trade receivables in the statement of financial position by pressing them to pay before the end of the financial period. Other methods of window dressing, such as changing the basis of calculating depreciation on current assets and the provision for liquidated inventory valuation, etc., are not permissible and contravene accounting standards. They may even amount to fraud. Income smoothing techniques. Income should be recognized as soon as it is realized and not before. A company carrying out work under a contract which spans 2 or more financial periods is required to spread the anticipated profit on the contract over the financial periods concerned. The amount of profit to be credited in each year is calculated by a formula which apportions the profit according to the amount deemed to have been entered in each period, less a prudent provision for any future anticipated losses. A more detailed explanation of contract amounts is also the scope of this text, as you are not required to have a knowledge of the topic. When the directors of the company may anticipate that a good trading year will be followed by a poor one, that may decide to relay invoicing some customers in the good year until the following one for the sake of appearance. This contravenes the concept of realization, and if the financial statements are subject to audit, should not be allowed to happen within being reported. Similarly, if customers are allowed to pay by installments for work done for services rendered and some by installments and are payable in subsequent financial period, any attempt to smooth income by partly deferring it until the installments are received would be a contravention of the realization principle. The nature of company forecast. Directors report and future developments. Director reports are required to include indication of likely future developments in the business of the company. These statements are usually quite brief and lack sufficient detail to enable shareholders and others to form an accurate assessment of the future funding requirements of the business. Company budget. Every company except some very small private companies prepares budgets. Budgets are based on forecasts and expressed in money terms. The programs or policies directors intend to implement to achieve a company's long-term objectives. The business budgets usually cover a period of 1, 2, 3, 5, 10 or large companies even more years ahead. Separate budgets are prepared for each of the company activities. Sales, production, purchasing, inventory holding and so on. Cash budgets are prepared from these budgets to show if the company is likely to need additional cash. Master budgets will take the form of forecast income statements, and statements of financial position will indicate when additional long-term loan is required. The budgets are for internal use within the company and are not published, but they are an essential management tool if the directors are to avoid the embarrassment and possibly the catastrophe of suddenly finding that the company has insufficient funds to continue its business. Banks and others approach to provide additional capital required to see the budgets before deciding whether or not to lend the money. Business budgeting is covered in chapter 32. How to prepare an income statement and statement of financial position from given ratios. The financial statement of business may be prepared from a list of accounting ratios provided at least one item is given as a numerical term. The method begins with the given numerical term and progresses by step from that. This chapter is important and is often asked as either a complete question or part of another question. Study the following points and work back through the chapter to make sure you are happy with all the calculations and what they are identifying. Learn the headings under which ratios are shown in pyramid of ratios and which ratios are included under each heading. Remember how each ratio is calculated in the model. Take care to calculate ratios in the correct figures and check your arithmetic calculations. Express every ratio in correct terms, for example, as a percentage, a number of times or days, a true ratio, and so on. Make sure you understand what each ratio is intended to explain. Your comments on ratio should be based on information you are given and justified by the ratios you have calculated. Do not assume facts you are not given. As you avoid making definite statements that cannot be supported by the information given, you may suggest reasons for the comments you make. Your comment should be concise and relevant. Avoid repetition of the same point. Avoid long rambling answers that stray from the point. When commenting on the ratios you have calculated, the wording is very important. Statements such as the gross margin is higher this year than last year are not sufficient. You must explain that this means that the situation improved or the company's trading was better or worse this year. Bullet points in the answers are perfectly acceptable and will save you time. Always use the relevant sign or wordings with the ratio. For example, a percentage sign after the calculation of gross margin or the number of times per dividend covered.